Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.
Kinross tops $1 billion in cash. Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mining Forum Americas in Colorado Springs. Joining me today is Paul Rollinson, CEO of Kinross Gold. Paul, welcome back to Kitco.
Thank you for having me.
Paul, second quarter numbers, some fantastic numbers there. 530,000 ounces of gold production, all-in sustaining cost of $1,500 per ounce, a margin of more than 50%, a free cash flow record of $650 million as your cash balance jumped to over $1 billion. And to top it all, your share price is up 140% year on year, seeing you lead the way amongst the large gold miners. Congratulations, a fantastic performance so far this year. What have you been most pleased about?
Well, thank you. No, and it really has been a great second quarter, great first half, as you say, with those record numbers. I mean, for me, it's all about the focus on operational excellence. And so what gets you to all of that is a real focus on the technical aspects of what underpins our guidance. So first and foremost, it's critical we hit our production targets. You hit your production targets, takes you a long way to what your cost target is. One of the things I'm most proud of is how we've been able to hold the line on costs. And the way you see that is we've had greater margin expansion than the gold price increase, which demonstrates we are holding the line on costs. So production, costs, margin expansion. Next thing is we did what we said we were going to do with the cash. That significant cash flow has gone right back into a very transparent message we've had around capital allocation. So, all the big mines, the Tasiast, the Paracatu's, the anchor tenants, firing on all cylinders. The U.S. has been doing really well. So, really pleased with the portfolio as it's generating this cash flow. And I guess I would also say if I look beyond the operations, I'm also really pleased with what's coming down the development pipeline. We are seeing better as we go results at Phase X underground. Things like Curlew, Great Bear's going really well. Lobo's starting to come in to view more. So not only strong operationally, but lots of good stuff coming in the development pipeline.
We've got a lot to unpack there, Paul, so we'll go through things bit by bit. Let's start off with the sort of cost aspect, because as you said, the gold price has been accelerating higher than costs, and that's pretty true across the industry, I think. But there's the risk that higher gold prices can mask the fact that costs are increasing. Everybody thinks they're doing a great job, and so for some companies, perhaps the eye gets off the ball of cost control. Is there still a lot more the sector can do and that Kinross can do to put a brake on cost increases?
Yeah, so we guided that our costs would be up about 8% year over year from 24 to 25. But this is a really good question, and it's an important point. The inflation aspect of that was only, say, 4%. What can also happen in mining is I call it the engineering effect. Where are you in your mine plans? And in our case, we went from 2.1 million in 2024 to 2 million ounces in 25. There's a numerator-denominator effect. So you produce 100,000 ounce less ounces, you're amortizing the fixed cost over, and it comes out as a per unit. It's not that we've lost our way or things have become more inefficient. It's an engineering answer. Similarly, where you're mining, where you're at. Last 2 years, we were at the bottom of the pit at Tasiast, over 600,000 ounces a year. The mine plan now has us at the top of the pit, working our way back down. Tasiast has gone down to 500 for a few years as we work our way to the bottom where the good stuff is. But at the same time, we've had an opposite tandem effect with Paracatu. When we were doing 600 at Tasiast last year, we were in the low fives at Paracatu. Now, Paracatu's back up towards 600. So a lot of times with costs, you've got to look through it. It's where are you in the mining engineering and the mine plan? And again, on that, I'm really pleased to say that in our development pipeline, we've got a lot more higher grade material we'll be bringing in, whether it's Phase X underground, Curlew, Great Bear. All of these will be higher margin. And so as we bring new stuff in, it'll be a natural offset to future inflation.
Okay, that's interesting. Now, a number of companies are very high margins at the moment. How sustainable do you think are high margins? At what point will they perhaps revert to the norm of, the average in the industry historically has been about 30%?
Well, I don't think, there's certain costs that seem never to go down. Like labor doesn't generally go down. Cost of living, inflation. Beyond that, it's really the physical characteristics of whatever it is you're mining. Are you deeper in a pit? Do you have a longer haul distance? What are the engineering factors? So we've been very focused on this, and I think that's, one of the things we've managed to do very well is hold that line on costs. I'm actually feeling pretty optimistic that as we go out into, say, the 28, 29, we'll be back into grades and we'll have an excellent cost situation due to that organic benefit of mining higher grade material.
Now, the higher gold price, particularly the recent increase, I guess gives you as a CEO a champagne problem of what to do with all that money that you're generating. You're sharing some of this gold bonanza with your shareholders through your buyback policy, through dividends. You've returned almost, $300 million so far this year. The gold price is up more than $300 since the second quarter. Is there room to give more back or perhaps more aggressively pay down your $1.2 billion in debt?
Yeah, great question. The way I would answer that is, I indicated it a moment ago, we've had a very clear, consistent message on capital allocation. And it's very simple. Number one for us, what's the needs of the business? Because we're technically mindset operators, we always get a check there. Our business is well maintained, which means it's a low risk business. The next question is, what are the needs of the balance sheet? And in 24, our focus was paying down debt. We did what we said we would do. We repaid the term loan that we put in place for Great Bear. To your point, we're essentially net cash today. But we look through the windshield and we want to keep growing some of that cash. We want to take out our notes that are due in 2027, $500 million. A Hollywood problem with the gold price also means I expect we'll have higher taxes and royalties, so we want to have a little bit more for that. And I guess the third point would be, not dramatically, but we see a lot of optionality in our portfolio, and we're not through our budget cycle. We'll know more as we get to the end of the year, and with our year end in February, we're seeing some great opportunities to reinvest in our business. So, look, we just turned the buyback on in the second quarter. I acknowledge the gold price is up since we started. We committed to $650 million return of capital. We will do that. But for now, let's just steady as she goes. We're only one quarter into it. We'll revisit all that towards the end of the year.
As you mentioned, Paul, you've got quite a development portfolio ahead of you, and we'll get into sort of the specific projects in a moment. But with a number of projects that will require financing in the future, to what extent are you sort of looking to build cash inventory, taking advantage of these high metals prices to build cash inventory to be able to sort of self-fund more of that rather than perhaps having to take on more debt?
Yeah, if you look historically, our capital spend is and it fluctuates, I could say around the 50-50, about $1.1 billion with an inflation assumption of both sustaining and growth capital. And all of that, including things like Great Bear, Curlew, Phase X, we can fund from our ongoing cash flow. So it's not that we need to build cash to do stuff. We have the cash flow. But what we are seeing is, for example, Phase X is looking better. We're 4.5 kilometers underground now, and mine life is growing. Curlew is looking better. So we may want to put more capital in and take that 1.1 up a little bit, just to optimize for the longer term operation we think we're going to have. So I would say we want to stay net cash. We want to continue with significant returns of capital. But we do want to grow our cash a little bit and maybe put more back into our business. And in this kind of environment, we can do all three.
Does having that additional cash available enable you to accelerate things?
No, I think we're in good shape there. We often get another question in this environment is, In the sins of the past, back in 2010, a lot of mining companies dropped their cutoff grades when prices went up. We will never do that. Our mills are full. And so we're goal-seeking cash flow margin. Said another way, we're last year we did our reserves at 1,600. We have 22 million of reserve, fully costed, like an all-in sustaining, fully costed reserve, 22 million ounces. On top of that, an M&I of 26, and on top of that, another 13 of inferred. So we've got a significant portfolio of resources. For us, mills are full. It's all about margin and competition for dollars for quality and margin enhancement.
Having a $1,600 per ounce gold price for your reserves when the gold price is at $2,000 makes a lot of sense, but we're way above that, so there's quite a delta there. To what extent or not is that an issue, or will that be an issue?
Yeah, it's a great question. I remember, I'm old enough that way back, I remember in the years ago, companies would have a higher resource price than spot. Well, we're certainly not there today, and it's a fair point. I think, though, because we're price takers, we're an industry of price takers, you have to be conservative. You always want to know you're going to be on the right side of the line with the gold price in terms of cash flow. We're not a manufacturer. We can't pass on our costs to the consumer. So I think what I expect is the industry will be dragged up, behind spot.
So kicking and screaming against the best instincts of mining engineers.
But, again, it doesn't sort of matter so much for the reserve resource. Like I said, we've got a ton of inventory. It's really more around, okay, if we decide to invest, what's the IRR? What's the payback? What's the capital? And, for example, even with those reserve resource prices, we ran our budget for 2025 at 2,500. Why? Well, it's a better reflection of reality. What are we going to be paying for taxes, royalties? So, look, I think we're all on the right side of the line. It's a Hollywood problem, but I think we should just be careful and disciplined as how we move those prices up.
Okay, we're obviously at an investor event here, Paul, and with record performance and numbers, the key question is, are you attracting new investors? Are generalist investors starting to come back to the gold stocks?
Yeah, I can only speak for our company, and I think we're definitely seeing more what I would call the generalist investor interest, and we've benefited that. I think, part of the reasons we benefit is, again, I wouldn't want to lump generalists into one group, but they often look at more financial metrics. They're not going to be as specific on all your assets. So daily liquidity matters. We've got huge liquidity. Sometimes up to 600 million a day of trade. Liquidity matters. Balance sheet matters. We're net cash. Dividend, return of capital matters. Our free cash flow yield is high single digit. That's a huge attraction. Track record. Our track record of delivering on guidance. So, our market cap now is quite significant. So I think when a generalist says, hey, maybe I should be invested in gold, I think they're going to go to the bigger names. I think they're going to look at some of those financial metrics. And I think in our case, we check a lot of boxes, and that's why we've seen more generalist interest.
Well, don't be too modest, Paul. You've been hitting the ball out of the park. The big gold companies, you're posting some of the best metrics. And so companies, generalist investors, looking at the metrics, you're pretty much the top of the list in many of those. So I imagine that's why a lot of generalists are coming to you. Sticking with one last question about capital allocation. You recently invested to maintain your 9.9% stake in Orion Gold in Finland. You recently sold some of your Asante Gold and White Gold shares. What's your strategic investment strategy with the juniors? And again, how is that evolving as we're getting into this gold bull market?
Sure, that's a great question, and there's sort of two different things there. Let me start off for context. So our annual exploration budget is about 175 million. That's what we spend every year. 90% of that is on brownfields, continuing to extend resources where we're already operating. But I'm a huge believer in having in-house technical greenfield geology expertise. So 10% of the budget is going into greenfield exploration. And that's a different mindset. That's a different geologist that's running greenfields than it is brownfields at a mine. That IP, if you will, that intellectual property is what guides our strategy with the investments. A lot of those juniors we invest in, the principals are geologists. They're all exploration geologists. If we like the team, the people, if we like the prosperity, that's really our strategy. And it's to build a relationship. We don't have any strings. We're not looking necessarily to get on the board or anything like that. We just want to build a relationship and be there if there's an opportunity to do something later. In the case of Asante and White Gold, that was more we sold an asset, and as part of the transaction, we took back some shares. So, we're not desperate to get out. It's not like we need the cash, but sometimes you'll get approached with a liquidity opportunity, and we may take a little off the table. But two different things. One is about getting on new stuff with people and prospects we like. The other two were more about, okay, we've been in there and good opportunity to have a little bit of a liquidity event.
I imagine in terms of portfolio management, you don't want a ridiculously large portfolio of junior positions.
No, exactly. I think the total of that portfolio, if you will, is about, and I say a lot of it is, we're talking ones and twosies. The bigger ones tend to be the divestitures where you're getting a block of shares. So, in that case, we're probably 100 million, that kind of number, and handful of companies.
Well, let's talk specifically about some of your projects in your portfolio. And let's start with Great Bear, because that's perhaps one of the best known of your development properties. That's in Ontario. You recently started an exploration decline there into the ore body, or towards the ore body. What's the aim there? What do you hope to achieve with that?
Yeah, good question. So we've divided Great Bear into sort of two phases. And I always joke we can come up with an acronym for anything. The advanced exploration we call AEX. And basically, the rationale or the strategy there is, we had very strong hypothesis of depth extension of the mineralization. We actually think it's orogenic, which means it's come from deep to surface. We've largely proven that hypothesis from surface drilling. So we've drilled 1.5 kilometers vertical, and in order to do that, you're drilling probably 2 kilometers on an angle. Those are very costly holes. So the AEX strategy is to get that decline, get down, get deep, and drill from underground. It's going really well. On our website, we've got some great photos. We've got a camp in place now to support the infrastructure and the team that'll drive that decline. It's going really well. In that case, in the AEX, the decline, that's very much an Ontario process, and we're getting great support from the Ontario government in terms of advancing that.
Okay, looking at further ahead with Great Bear, as you move getting towards a mining scenario, what's the timeline on the various studies and the permitting that you require on that, and how's your concept of what the mine will look like? How is that evolving?
Yeah, I probably should have started with that. It's a good point. I was just thinking as you were talking, it was 1 year ago, just before this conference, we daylighted the PEA, and it's just a fabulous asset. 500,000 ounces a year at an $800 all-in sustaining. If you were to, in the context of today's gold price, that's $1 billion a year of free cash flow just from that asset. So it's really phenomenal. I just explained the AEX timeline and the fact that we're trying to get underground to drill. On the main project, this time we're dealing with the federal regulators. And we've been doing environmental baselines since we owned it. So we're 3 years into environmental baseline studies. We're starting to submit impact statements to the federal government. So impact statements, we're going to do 3. That's the plan. There'll be 1 going in shortly, 1 towards the end of the year, and 1 in the first quarter. We've already got a great dialogue with the federal regulators. So our objective is comprehensive submission, no surprises. And what we're expecting is, if we look at precedent, we'd get a permit to start constructing, to build a mill, to operate a mine in 27. From 27, we probably have 2 years of construction. So that sees sort of first gold pour in 29.
Canada's Prime Minister Mark Carney, he's spoken a lot about the need to accelerate permitting of infrastructure projects such as mines, accelerating that. Are you seeing any potential benefits for your process through that initiative?
Yeah, look, I think we're hearing great things from Ontario, and we're hearing great things federally. We're early days into it. Some of these things have been, talked about but not fully enacted. But I'm optimistic for the future, and I do think that this is such a no-brainer. We're off the paved highway, 20 minutes from Tim Hortons, in a mining town. We have a power line, we have a natural gas line. Very straightforward, and I expect we'll get great support federally as well.
Okay, let's move a little bit further south to Nevada, where you've been very busy as well. You've got your Round Mountain and Bald Mountain operations there. You're putting in a lot of work and a lot of investment to extend the life and find new mineralization there. Paul, bring us up to date with how they're shaping up.
Well, both sites are doing really well. The production was up at both Bald and Round, and cash flow's obviously been up at both Bald and Round. As I touched on it earlier, Phase X is super exciting. We always had this hypothesis, we've taken 20 million ounces out of the open pit, and our geologic hypothesis was that the conduit or the plumbing was from depth. And so, we decided to dive right in, and as I said, we're now 4.5 kilometers of underground development, and what we're seeing is it just keeps going. So that's super exciting. Grades, widths, it's going to be this is one of those organic things we'll look to turn on in 2028. That'll be, again, a natural offset to inflation by mining higher grade material. And then at Bald, you may recall, we got something we call the Juniper permit towards the end of the year. That caused us to give a green light to Redbird. In doing that, we converted a million resources over to 1 million ounces of reserves. We said at the time, and if that goes well, and it has gone really well, we'll be looking about a decision on Redbird 2 towards the end of this year. And based on where we are today, I'm pretty optimistic that we'll turn on Redbird 2 towards the end of the year. So Nevada's been going really well.
Okay, we haven't got time to talk about all of your assets, but while we're still on your projects and assets, I'd like to sort of focus on Chile and La Coipa, where you're looking at the future potential of the Maricunga region, not just at your La Coipa mine, you've got other opportunities there. How is your Chile strategy advancing in this gold price environment?
Yeah, Chile's great. I always say your Chile strategy is what's your water strategy. Because as gold miners, as compared to base metal miners, we use about 1/10 of the water. So we still draw continental water. We pump water out of the ground. In our case, that's a really good thing because we've been permitted and pumping water for many years. Why is that good? We have hydrology. So it's not a thesis or a theory. We can demonstrate no detrimental impact to our drawing of water. So our strategy is to mine La Coipa to the end of the decade. Our water wells where we draw water are actually closer to Lobo, and then click over to lobo-marte towards the end of the decade. Now, Lobo is going to be a fabulous project as well. Looking at about a 16-year mine life, probably about $1,000 AISC, and 350,000 ounces a year of production. So it's going to be a great anchor tenant in the portfolio for the 30s. And we have about 7 million ounces of reserves at Lobo. And then behind that, we have Maricunga itself, where we have another 10 million ounces. That's longer term, longer dated. We would have to do a full environmental baseline. We have to think about water, but it's great optionality in the portfolio for the future.
And of course, over the last few years, the water options have extended because there's now private companies with desalination plants, utilities, etc., that are looking to supply third-party clients such as miners.
Yeah, and I think that's certainly the case for the base metal guys, but certainly, there is a bit of a supply-demand. It's almost, I think of water in the Atacama like I think of electrons. It's it's an infrastructure. No, we're very happy with Chile, and the outlook's really strong.
Okay. I want to finish up with a question about the overall competitive landscape in the gold space. With the divestments from Newmont and Barrick, we've seen a number of new gold producers. The mid-tier is getting pretty fat. We just saw a large mega merger in copper. It's been 5 or 6 years since we last saw a mega merger in the gold space. Is a mega merger necessary now in the gold space? Are investors calling for this?
Yeah, I don't think it's necessary. I don't think investors are calling for it. I'm a believer in consolidation because there'd be better capital budgeting. Sometimes things get built, maybe that shouldn't. I think with consolidation, you'd have more discipline into what gets done and what gets spent. So in general, I support consolidation, but at the end of the day, it's very case specific. I mean, M&A is meant to create value, and in the mid-cap or smaller space, it might be combining for capital reasons or sharing of capital risk. And, in our case, it's often about synergy. Is there a synergy we could find? Is there something you could do better together than alone? In the base metal example, there's some very big capital for either company. So, I would argue maybe a synergy there is sharing the capital. I don't think you can necessarily extrapolate what just happened in copper to say we should expect that in gold. I think it's going to have to be case-by-case value accreting for both companies, a better scenario than a standalone. And that's got to be some combination of shared risk and, synergy, savings and synergies.
Okay. Well, Paul, congratulations on a great year so far. A lot more to come. Paul Rollinson, thank you very much for joining us today.
Thank you for having me, Paul. Thank you. Great to be here. Good luck with the rest of the conference.
Thank you. We have a lot more to come from the 2025 Mining Forum Americas here in Colorado Springs, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.